Hello everyone, welcome back to my YouTube channel. In the last class, we learned about provisions of Partnership Act relevant for accounting, right? So in today's class, we are going to learn about maintenance of capital accounts of the partners. How capital accounts of the partners are maintained. So there are mainly two methods by which the capital accounts of partners can be maintained. Their first one is fixed capital method and fluctuating capital method. So using these two methods, the capital accounts of partners are maintained. So let's see one by one. In that first one, that is fixed capital method. See, under this fixed capital method, the capital of partners remains constant. The capital of partners, that is, remains constant. Clear? So unless there is additional capital introduced and permanent withdrawal of capital. So under fixed capital method, capital of partners remain constant unless there is additional capital introduced and permanent withdrawal of capital. It means what? Additional capital introduced. Unless additional capital is introduced or a part of the capital is withdrew as per the agreement among the partners. So, it means first one is additional capital introduced. It means a partner brings extra money into the business apart from the initial capital. Clear? So, for example, Ravi, see here, for example, Ravi started a business with rupees 1 lakh. With rupees 1 lakh. Clear? Later he adds rupees 50,000 or more. So this 50,000, that is called as additional capital. Additional capital. First he started business with rupees 1 lakh, but later he introduced rupees 50,000 as additional capital. So this is recorded in the capital accounts of the partners. Clear? Now next one is permanent withdrawal of capital. It means what? It means partner takes back a part of his capital permanently from the business. Means here Ravi's capital is rupees 1 lakh. He withdrew rupees 20,000 permanently. Clear? So now this 20,000 recorded in the capital account and his capital becomes rupees 80,000 because he withdrew the amount of rupees 20,000 permanently. Right? So I hope this is clear to you all. So in this fixed capital method, mainly two accounts are maintained. They are capital account and current account. Clear? So for each partner, two separate accounts are prepared, capital account and current account. So first let's see the capital account. It means what? Shows only the opening capital, additional capital and permanent withdrawal. Balance usually remains unchanged. Clear? Only these three information is there in capital account. So let's see the format of partners capital account. Write down at each side of the account, that is debit and credit. Clear? See here. By balance brought down, opening balance, and by bank any fresh capital or additional capital is introduced, and to bank permanent withdrawal of capital, and to balance carried on, closing balance. Clear? This is the partner's capital account. And so first one is here in fixed capital method, mainly there are two accounts are maintained. First one is capital account. In capital account, that shows only opening capital, additional capital and permanent withdrawal of capital. And second account, that is current account. So in current account, all regular adjustments are recorded here, such as drawings, withdrawal of amount by the partner, interest charged on drawings, interest charged on capital, salary to the partner, commission to the partner, share of profit or loss. For this we need to prepare the profit and loss appropriation account. So here I will explain this in the later classes. Clear? So these all are information included in the current account. So let's see the format of current account. See here, in the partner's current account, see, by balance brought down, in case of credit opening balance means that is if there is any previous current account of the partner, here we need to brought down the amount, clear. And next one, salary to the partner, by salary, by commission, by interest on capital allowed, by profit and loss of appropriation means share of profit, it goes to credit side, and share of profit and loss account, share of loss, that goes to debit side. For this we need to prepare the profit and loss appropriation account, then we can find whether there is share of profit or share of loss, clear. So I will explain that profit and loss appropriation account in the next class, clear. And by balance carried on, in case of debit closing balance. And here also same, to drawings, to interest on drawings. To drawings means withdrawal of amount by the partner, interest charged on the drawing. To profit and loss account means share of loss. To balance carried on, clear. This is the partner's current account. So in maintenance of capital accounts of partners, there are mainly two methods, fixed capital method and fluctuating capital method. Now just we have discussed about fixed capital method. In this method, the capital of the partners remains constant unless there is additional capital introduced and permanent withdrawal of capital. And in fixed capital method, there are mainly two accounts are prepared to each partner, that is capital account. In capital account, it shows only opening capital, additional capital and permanent withdrawal of capital. And second one is current account, that shows the adjustments that are recorded here. They are drawings, interest on capital, salary, commission, share of profit or loss, clear. Fixed capital method is clear, right? So next one, that is fluctuating capital method. So in fluctuating capital method, what happens, as the name only says, in this method only one account is maintained for each partner, that is the capital account only, clear. All adjustments are recorded, means in like fixed capital there are no two accounts, here only one account is maintained for each partner, that is named as capital account. And all adjustments are recorded directly in the capital account, clear, such as share of profit or loss, interest on capital, drawings, interest on drawings, salary or commission. So now it is called as fluctuating capital method. Why? Because the capital balance keeps changing every year. Because the capital balance that keeps changing every year means in this method all items are recorded in the same capital account, such as see, profit increases capital, loss decreases capital, and drawings decreases the capital, interest on drawing increases the interest on capital increases capital, right? So because of these continuous additions and deductions, the capital does not remain fixed. So that is why it is called as fluctuating capital method, clear. So I hope this is clear to you all. Now let's see the format of partners capital account. See here, same as partners current account in the fixed capital method, clear. So here by balance carried on, that is the previous partner's capital account, and by bank, salaries, interest on capital, bank means any additional capital introduced here. Here we will not prepare separate account. All the adjustments are recorded in only one account, clear. Salary to the partner, interest charged on capital, profit and loss appropriation account, and by balance carried on. On the debit side, two drawings, interest charged on drawings, profit and loss for share of loss, to balance carried on, clear. In fixed capital method, two accounts are maintained, partners capital account, in this only opening capital, additional capital and permanent withdrawal of capital, and remaining adjustments are recorded in the current account. But in fluctuating capital method, here we will maintain only one account, that is partners capital account. In that only we will record all the adjustments. Clear? So I hope these two methods are clear to you all, that is fixed capital method and fluctuating capital method. So in the next class we will solve one practical problem under fixed and fluctuating capital method. So if you have any doubts in this class, please leave a comment. Thank you.